Hello, thanks for joining us today. We're going to be looking at significant cross currents in the markets and the economy and how it's impacting the way we're looking at the markets and client portfolios. So, to get more specific in terms of what exactly, we're just going to give a brief look at the returns of the stock in the bond market this year. Going to look at stock valuations and what's priced in to stocks at the current valuations. And then we're going to look at really the main piece of this presentation, which is the cross currents. So we're going to look at data that supports lower rates, lower inflation, lower growth, and indeed a possible recession. But then we're also going to look at a substantial amount of data that supports the exact opposite. So we're going to look at hard data that supports stable or even higher inflation, growth, higher rates, and probably no recession. And then lastly, we're going to look at, how different pieces of our portfolio are used to hedge against both scenarios of higher inflation, higher growth, or lower growth, lower rates, and a possible recession. And then, of course, no matter what happens in the short to immediate term, staying the course is, the main thing. And that's our job to, short to immediate changes we will make in the portfolios given this data. So first thing we'll look at just really quickly to give you an idea. So far in 2023, it's been an overall good year. Stocks have done well. So stocks are up about 14, 15% so far this year. Bonds are up slightly, just above flatline. Rates have actually creeped up pretty materially lately, and that has brought the prices actually down a little bit this year, but there was enough interest basically just to offset that. And then stocks really were powered by mostly tech earlier in the year, and that has lessened over the past couple months. But other sectors like energy have sort of taken up the ballast there. So far, a good year, very good year for stocks, or good year for stocks. Break even, slightly up for bonds. We're not going to really talk about them in this presentation, but alternative and privates continue to do their job. So they're up about, call it 4%, a little over that so far, on pace, if this continues at the same pace, for about 7% or so this year for the alternative or private investments. And then on the stock valuation, it's important to us in terms of the long term. This is not a good predictor of short-term movement at all in stocks, but it does give you an idea over the next 5, 10 years what we can expect from stocks. And if you go back to middle of the year, fall of last year, we're pretty cheap. So stocks are trading about 15.5 times earnings. Right now, corporate earnings have basically stayed the same, even dropped a little bit over the past year, but prices have moved materially higher, especially in tech. So what that has produced is more expensive stocks. So right now they're trading, instead of that 15.5 times last year, they're just shy of 20 or 19.5 or so currently, and that is moderately above average. So average is about 17 times, we're at about 19.6. So, it's somewhat expensive. It's not alarmingly expensive, but somewhat expensive. So, we take that into account, but it's not a huge factor, especially not at all in the short to immediate term. And, going back just quick, on that point, what that is basically pricing in would be a soft landing. So it's saying, we're going to get out of this without any hard recession. We're going to get out of this with inflation coming down. Maybe not perfect, but a pretty nice soft landing, sort of in the middle, threading the needle. And certainly we hope that's what happens. Now, as we go into the different cross currents and the data we're seeing, first we'll look at the data that is supporting lower rates, slower growth, lower inflation, and indeed a possible recession. So the first one is actually good news. So this is CPI, inflation over the past 3 or 4 years or so. And as you see, in the middle of last year, middle of last year, CPI spiked to 40-year highs, up over 8%. It was an incredibly high recession, although, knock on wood, seemingly very, very short-lived. So we went up there pretty quickly, and we're coming down from those levels very quickly. Right now, depending on how you look at it, headline is probably 3.5%. Core CPI is still higher than that, so that's in the 4s. But regardless, both are coming down pretty quickly and to a large degree. We'll see what happens from here. I think a lot of the easy CPI or inflation lessening has happened, and we'll see what happens from this level if we continue lower into the 2s, or if we sort of stabilize out here and maybe stay in the 3s or even 4s. But so far, this is really good news, coming from 8 to 9%, which is horrible for corporations, individuals, basically everybody. And even at this point, it's a significant improvement, coming all the way down into the 3s or 4s, depending on how you look at it. So that there certainly does support lower growth, lower inflation, which is good news on the inflation side. But, maybe, if that were to continue and we go to near zero or deflation, that would be recessionary. That we do not think that is happening, that deflationary scenario. So another data metric that would be used to look for a recession, and again, lower rates, lower inflation to go along with it, is the leading economic indicators. So this is a chart. The blue line on here is leading economic indicators. And what that is, it's a collection done by the Conference Board, which is an economic organization that has done this for decades. It's basically a collection of metrics that historically, if you put them together, have predicted recessions. It's looking for metrics that have a predictive ability to them. So they're leading, not trailing, but leading economic indicators. So right now, according to this graph on the blue line, once it gets to a certain point below zero in terms of change year over year, at the current time, it has never gotten to this point before without triggering a recession. So it doesn't mean necessarily it has to happen this time. But if you look at history, it's never gotten to this level before without having a recession, and there's also been no false signals. So we view this, we see this, we're cognizant of it, and we are making some hedges in the portfolio partially because of this. Another such data point we look at that also points to lower inflation, lower growth, and a possible recession would be the yield curve inversion. So this is a chart going back about 45 years that is looking at each time the 10-year yield dropped below the 2-year yield. Normally, the further out you go with a treasury, the higher yields get. Anytime you see the blue line below the zero, that means short rates are higher than long rates. And that has always caused a recession in the past historically. Again, every single time that has happened, it has predated a recession, somewhere between 6 months and 2 years. So there's a lead time in there. And there has also been no false signals. So this has historically been a very good indicator of a recession. Doesn't give you a great idea of exact timing, but it does give you a good idea if there's a recession somewhere in the relatively near future. We have inverted about a year ago, so we're 12 months into this inversion. So if you go by this, yes, it is pointing to a recession. And again, this time certainly could be different. But again, it's in our data, it's in our models, it's in the portfolios. We do have hedges, as this, again, is another metric we use to pull in everything within the portfolio hedging. Now we'll sort of turn the page, and this is where we get into the cross currents. So we just reviewed all the data metrics we see that point to lower inflation, lower rates, possible recession. Here's the opposite. So at the same time, which is rare, we're seeing conflicting signals here, those cross currents. So this is data points we're seeing that's higher inflation, higher rates, higher growth, and no recession. So the first would be interest payments from the government. So this is interest payments paid by the government on government debt, so treasuries. And this chart goes back 20 years. And what you'll notice, it's gradually risen over the years, but interest rates were suppressed during this middle period for the last 15 years. And until recently, it has really shot up. So surprisingly, the government payments have increased more in 1 year than in the past 20 years in dollar terms. So that's a tremendous amount of money. About $400 billion in annual interest payments is being paid to corporations or individuals that hold these government bonds. And that is in a way, a form of stimulus. It's a lot more income or money coming to corporations and individuals that hold government bonds. And what did they do with that interest? They could reinvest it. They could put it into other investments. They could spend it. So regardless, it is sort of like a stimulus. In addition, even if they're not in treasury bonds, they can be in savings or CDs or other forms of short-term interest instruments or cash investments. And those have increased a lot in rates as well. So if you add that on top, total between the 400 billion in treasury payments, another 240 billion or so in money market type interest, you have 650 billion per year of additional money entering the system to individuals and corporations. And if they choose to spend it, invest it in other types of investments like real estate or stocks or things like that, that is stimulative. And that would support higher growth, higher rates, and possibly higher inflation. And then these are two other data points. One, employment or unemployment is very important. So this chart on the left, that red line indicates unemployed persons per job opening. So another way to look at that is saying currently, for every job seeker, there are almost 2 jobs available. So 1.7 jobs for every job seeker. It means it's a very tight labor market. When you have a very tight labor market, or a labor shortage, if you will, in this case, that's supportive of wages, of wage gains, and again, that is inflationary, that's higher growth, people have more income to spend, which is good, that's good obviously, but it also does sort of push rates and inflation higher on average. And on the right, the same supply story. So this is a housing supply story. This is a chart of going back, these are 2017, 2018, 2019, 2021, and this dark red line is the current year in terms of housing supply. As you see, we are currently in a pretty low supply situation of housing, and that's a combination of, with these much higher mortgages, nobody wants to get rid of their low mortgage that they locked in over the last 5 to 15 years. So they're stuck, basically, in a good way, in their houses. So that takes those houses off the market, essentially, unless you're forced to sell. In addition, because of higher rates, there's not as many new houses being built. So supply is short in the housing market, and that does, to some extent, put a floor underneath prices. And maybe even for the latest data we're seeing, housing prices are stabilizing in a lot of markets. It's all local, but in aggregate, if you look at the entire nation, stable or even increasing housing prices again, just because of very suppressed supply of housing. And again, that is higher inflation, higher rates, higher growth. Rates themselves have gone up materially over the last, call it 3-4 months. So this is a chart of 30-year yield for treasuries, and that has gone from about 3.7, 3.6, all the way, we sit at about 4.3% now. So a 0.6% move in 4 months is very material, and we have seen that in bond prices. And that also does indicate, over the long term, these are 30-year bonds, so this is long-term, very long-term looking, indicates, possibly higher growth, higher inflation, higher rates for a longer period of time. And then the last piece here is oil or energy. So energy, was fluctuating around for 9 months or so, between $60, $75 a barrel. Recently, we've been about 68, 70 for months, and over the past 3 months, gone up 20%. We're just above 80 currently. And that's sort of signaling, okay, we maybe, at least for now, avoided a recession. We're in for higher rates, higher growth, and possibly higher inflation. Energy itself is a part of inflation, so obviously that points in that direction. So if you put all those data points, together, you can make a pretty good argument for stable or higher inflation, higher rates, higher growth, despite other metrics pointing the other way. And, when we look at this environment, it is conflicting. And that's why in our portfolios for our clients, we have hedges on both sides. So it is a very unique environment where we see, as we just went over, both sides of the equation. We see arguments on both sides. And that's why we have hedged client portfolios for both scenarios. So if we do end up in a higher or stable inflation with higher rates for longer, higher growth, we want high free cash flowing stocks, we want value stocks, we want healthcare stocks, we want energy pipelines, we want infrastructure, things like that. Those tend to do well like they did last year when we had higher inflation, high economic growth, and things like that nature, higher rates. At the same time, if those other data metrics prove to be correct, we want things to hedge recession risk or slowdown risk. Those would be mid to long-term treasuries would do very well. Some growth stocks, technology stocks, we like equal weighting in technology stocks. We think the biggest of technology stocks are overpriced, so we choose to equal weight the technology stocks. And utility stocks, which are defensive, those should do well or relatively well if we go into a slowdown recession. And then for our most risk tolerant clients, digital assets, a recession should have no impact on those. And then we have three pieces that really it doesn't matter. So we could go higher inflation, higher rates, we'd go into a recession, has no impact on insurance-linked securities, little to no impact on private credit, and no impact on principal on short-term T-bills or 1 to 3 month. You might get a lower rate if we go into a recession, but it will not impact the principal. So those three things, no matter what scenario, we should be okay. And most clients have all these things with the exception of digital assets in their portfolio. So you are well hedged regardless of what outcome we see with this uncertain macro backdrop. And this, again, this is a chart. In the last video, I looked at something similar where these are all our risk holdings, or most of them. TPYP is our pipeline exposure, energy exposure. COWZ is our high free cash flow strategy. AVUS is our accounting adjustment strategy. And then on the very bottom, you have the S&P, and then healthcare is right there with it. And this is just showing, going back to the beginning of this transition period, if you will, the beginning of last year, almost all, except for healthcare, of these risk pieces we have in our portfolio, this is not looking at bonds, this is not looking at the alternative or private investments, just the risk part of our portfolio, or the stock part. All of them are outperforming the S&P over the last year and 3/4, year and a half, but it goes through different parts or cycles. So the green areas on this chart represent where our strategies are doing better than the S&P. The red would be the opposite, but overall they are outperforming, and we would think that would continue over the long term. And then the last piece of this is everything that I have talked about here is short to intermediate term. So 1 year, 1.5 years, maybe 2 years, and that's fine. What we're doing is to try to maximize the return you get for the risk that we agreed to. That's our mandate to you. And we will make changes in the portfolio based on that, at the same time hedging where we feel appropriate. So that's our job, to worry about the short to intermediate term. But the most important thing here is, regardless of what happens here in the next year or two, is to just stay invested, stay the course of whatever strategy you are in, along with your retirement plan. That's by far the most important. We take care of the, selling this, buying that, hedging here, moving into that, moving out of this. Over the next, 6 months, year and a half, we always look for the best investments. But the most important thing is just stay invested, stay the course. You are, over the long term, as this chart points out, this goes all the way back to 1900. And it goes through, World War I, the Great Depression, World War II, assassinations, oil crisis, it goes the Great Financial Crisis, COVID. All bad things happen through time. But as you'll notice here, the U.S. stock market goes up over time. And that, that's been the overarching theme of being invested. Just stay invested, stay the course. We'll take care of the short to intermediate for you. And hopefully you enjoyed the piece. Thanks for joining us today. Any questions, let me or your trap hanging advisor know. Take care.